We'll go ahead and get started. Um, First of all, thanks to everyone for your attendance. This is the second event that we've done this year with this trustee only invitation on how to review and manage life insurance as an ILET trustee. This series is a three-part series. The first program beginning today on universal life. We'll be doing a follow-up to this next Tuesday, and then another follow-up the following Tuesday, same time. My name is Mike Smith. I'm president of TFP Brokerage. I'll be presenting with Steve Hutchison, who is the founder and president of Policy Check. So you can see on the right side what we're planning on covering today, so we'll go ahead and get started. All right. So first of all, we're going to start with policy management at its worst, and I apologize for this poor copy, but this was actually a real-life situation that I was confronted with back in 2008, and it's an example of what can happen when things go wrong with universal life insurance. So I know this is hard to read, and I apologize for the bad copy, but I want to get to this. So this was a $1,580,000 policy with a major carrier. It was ILET owned. Their son, who I knew was the trustee. There were two beneficiaries of this trust. Excuse me, three beneficiaries, two in addition to him. He actually became the president of a publicly traded company. So he had a lot of responsibility. He was very busy. And so you can see what happened in 2007. The cash value dropped from $331,000 to $183,000 in 1 year. So then, the end of 2008, I get a call, and the cash value dropped from $183,000 to $121 in that year. And the call that I received, and this is the call that none of us ever want to receive, and by the way, I didn't write and was not managing this policy, was, hey, I have a paid-up policy with this company, but my cash value is plummeting. Do I have an issue? And as it turned out, it was, Dad was 92 years old. He was in decent health for his age. What it was going to cost to get this policy out to maturity was in the neighborhood of $400,000 a year, because as you can see, these mortality costs go up substantially every year. So, this is what we don't want to happen, and this is a situation we never want to deal with. And if this situation had been approached much earlier and been managed in a manner similar to what we're going to discuss today, my guess is this would have never happened. And there's just a 2-year summary, the same numbers. All right. So now we know what we don't want to happen. What we do want to happen is that we want to properly manage these policies so they pay off at the grantor's death and meet objectives and hopefully provide the bank or trust department the opportunity to manage the proceeds from the policy. So let's start with some basics here. What is the purpose of an ILET? The purpose of an ILET, as far as and most of them, almost all of them that I've ever been involved in, is to set up a legal entity to apply for and purchase a life insurance policy on a insured, typically the grantor, so that that trust and the benefits of the trust avoid estate taxation, gift taxation, income taxation, and are exempt from creditors. And normally the primary purpose of the ILET is to provide liquidity and have the policy actually pay off at the grantor's death. The problem is, if any of you have ever heard me talk about this before, the problem is that there's almost 50% of institutionally owned life insurance policies are at risk. And this is not getting any better in this interest rate environment. because the carriers are suffering from these low interest rates. All right, and so so we have some guidance also from OCC and actually a recent court ruling about what these particular entities view as the responsibility of a fiduciary over a ILET. And so up at the top is OCC's guidelines from their August 2012 handbook, stating that pretty obvious stuff. Bank fiduciaries are responsible for protecting and managing the policy for the benefit of the beneficiaries. You're responsible for understanding the policies that you're managing, and if you don't, there's recommending retaining a third party to help you prudently manage these assets, that you should be looking at these policies once a year, and the review that's conducted should evaluate the carrier strength, whether the policy is performing, and whether replacement should be considered. So that's OCC. Now, Nebraska Supreme Court just had a ruling back last November that was filed in February. It's the first case that we're aware of where the plaintiffs who were ILET beneficiaries actually prevailed in court. We're aware of situations that have settled in the past, but this is the first court case. And as a court has a habit of doing, in their opinion, they wrote that the trust fiduciary has a responsibility for agreeing with the grantor on who's going to monitor and manage the policy. The obligation is to manage the policy in good faith for the best interest of the beneficiaries, and to keep the beneficiaries fully informed so that they can protect their interests. All right, and so that's guidance that we've gotten. So on a very, very high level, what is it that we need to be doing as life insurance fiduciaries? Protect and manage the policy, understand the policies that you're managing, and including the riders and whatever options are out there, or retain a third-party advisor to help you. And the review should evaluate the financial strength of the carrier, whether the policy is performing as it's supposed to, and whether replacement should be considered, and always keep beneficiaries informed on policy performance. All right, so that's the standard that we all should be attempting to meet in managing life insurance. So today we're specifically, or actually the next three series, including today, we're specifically going to talk about universal life. And there are 6 different types of universal life. And by the way, second to die policies that are universal life mostly reside on these kind of policy chassis as well. We are not going to cover variable today. That'll be another series in and of itself because of the moving parts in a variable policy. But so there's 6 types of universal life, 5 of which we'll talk about today, but they all act differently, and they all have different key policy components that are important to you as a fiduciary in understanding what you should be looking for and what you should be asking for from the carriers as you're trying to manage these policies. So the first type we're going to discuss is what's called current assumption universal life, and that is probably the most common policy. Well, it is the most common policy out in the marketplace. These are what you'll see the most of in the marketplace today. The policy, current assumption universal life policy performance is based on a declared interest rate. The carrier declares what the rate is. Okay, so when you're looking at illustrations and annual statements, first thing you need to know is what is the crediting rate that this illustration is based upon. We also want to know what the rationale is supporting the illustrated rate, because what you'll find, what we have found, and if you're managing a lot of insurance, you probably found the same thing, that you get all kinds of different crediting rate illustrations on policy, some of which make sense and some of which don't. So you have to be really paying attention to what rate it is that the carrier is providing you in an enforced illustration. And then if they're illustrating a rate now what is the current crediting rate on the policies that are in force other than this policy as it's being illustrated, perhaps at a higher or lower rate. Then, does the policy have a no-lapse guarantee? How long is that for? What are the riders and how do they impact the performance of the policy? And then how long is that policy projected to last? So, and by the way, we're going to send you a PDF of this presentation afterwards. So hopefully that'll be helpful to you in carrying out your duties. So next type of policy is the guaranteed premium universal life. The policy performance is based on meeting conditions, but the primary condition that needs to be met for a guaranteed premium universal life policy to perform is that you're meeting the aggregate minimum premiums on time. So there is some flexibility in this type of a policy where you can pay more in earlier years to maybe perhaps not pay as much in later years. The testing of the guarantee is going to be based on the aggregate minimum premiums. And then the same type of questions: what's the interest rate? What's crediting rate used on the illustration? What's the rationale behind it? What is this policy actually paying now? And does that match up with the crediting rate in the illustration? What are the riders and how they impact the policy? And how long does the guarantee last? And we recommend, as you'll see in our Universal Life in-force request at the end of this, and we'll be emailing you one of those as well, we request that you get that in writing every year. Carriers make mistakes on this, and it's important that you always retain your original illustrations that you've received in the past, in-force illustrations that you've received in the past, and that you're comparing that to the information you're getting, because we have seen cases where somehow the guarantees, according to the carrier, have been violated, but there's no deviation from what the past illustrations have shown. So again, people make mistakes and carriers make mistakes, and I think it's our job in managing the insurance to make sure we're catching that, and we are aware that it sometimes happens. Okay, now, no lapse guaranteed universal life has been a lot more popular here in the last probably 8-10 years. It varies from a guaranteed premium universal life significantly in that the performance of the policy is based on meeting conditions, but it's based on meeting scheduled premiums on time. And what I mean by that is the majority of the carriers that are issuing no-lapse guaranteed universal life and have issued no-lapse guaranteed universal life have a provision in the policy that if you pay it too early or too late, you can violate your no-lapse provision. Okay, so there's a window of time. It's typically not spelled out in the policy. A lot of times the policyholder service people don't even know what you're talking about when you're asking them these kind of questions, so which means you have to go up the ladder and talk to more knowledgeable people that are more experienced. But what I'm saying here is that you can actually pay the policy early and violate your no-lapse provision in no-lapse guaranteed insurance. In fact, it's a fairly consistent violation of that policy provision. So when you hear me talk about gotchas in policies, that is certainly one of them. So the same thing you're looking for on these illustrations is crediting rate, rationale behind crediting rate, what's current interest rate they're paying, what are the riders, and then you will see in our request how long is the policy guaranteed to last. We want that in writing, and if the no-lapse provision has been violated, what is the makeup provision? I'm going to show you in the next series some makeup provisions that actually took place that we were involved in as an agency, and they can be pretty egregious. So you don't want to be paying these premiums too early or too late on a no-lapse policy. Index universal life. Index universal life has become more and more popular here in the lower interest rate environment, and it actually has a fairly important, I guess, place in the market. The index universal life is similar to variable life in that the return of the policy is based usually on some kind of market return. So whereas a variable life policy has no floor or no ceiling in terms of how much in 1 year or in any period of time that the funds in the policy can either gain or lose, in an index universal life policy, those caps and floors exist. So in other words, the most popular form of an index in an index life is an S&P 500 index. And so when your money is invested in an index in a universal life, it's not actually put into the market. It's held by the carrier for crediting purposes, depending on what the index does in the time frame that it's designed to either or to perform. So in other words, the most popular type of index in today's marketplace is it was a 1 year point-to-point S&P 500 index. What that means is if you start on January 1st in a year, then on December 31st, and the index was $1,000 at that point, or 1,000, excuse me, and then at the end of the year, at December 31st, it was $1,100. There was a 10% return that would be credited to the policy. These indexes, and it'll be credited after the anniversary of that time cycle. So most of these indexes have a floor of 0. Some have a floor of 1%, so it cannot lose money. In fact, the worst it can do in a year is make 1%. And all of them have participation rates that are not guaranteed. Most of them are at 100% right now. And all of them have caps on them. The most that you can earn in the period of 1 year, they're typically between 10 and 12%, and those are not guaranteed as well. So the idea is that this type of policy will outperform an interest-bearing policy, particularly in this type of a market, and that you won't suffer the large downside that you would in a variable policy. So then the same rationale is applied to this policy when you're managing it, and that is, what's the index crediting rate being illustrated? Now, I recently, you'll see in our in-force ledger request, we're asking for full disclosure on what the crediting rates are, and unless we make an error on our end, we're telling the carriers what rate we want them to project their returns on based on very specific rationales that we have behind why, what type of structured index and how it will perform over time. But if you don't ask for that specifically, I actually got an in-force ledger request back from a carrier, a major carrier, on an S&P 500 fund where they were illustrating in the future 8.4%. I didn't ask for it. I didn't want it. I had to go back to them and say, no, we're looking for 6.67 on this one. But those are the kind of things you'll get from these carriers. And a lot of times, unless you really understand how these in-force ledgers work, you won't even know it. And so that's another one of the gotchas that I think is important that you're aware of. If you're managing index universal life, you have to pay very close attention to what crediting rate these indexes are in the illustrations. All right, so same thing. What's the rationale behind the rate? Is there a no lapse guarantee? How long does it last? What are the riders? Okay, and if there is some kind of a guarantee on the policy, requested in writing. Then the last type of universal life we're going to discuss today is term universal life. And term universal life probably won't be used very often in islands, although it could be. So these policies are not designed to be, they're not term policies, but they look like a term policy. And unless you know the difference in what you're looking for, you may never know that what you actually bought, what you thought was a term policy, was a universal life. I see it all the time. And it's priced as a term policy, so it really should be managed similar to a term policy. So it's just like a level term contract where it offers a level premium for a level period of time. The premiums are flexible as long as minimum premiums are paid in the aggregate. The renewal options at the end of the level term period differ widely among carriers. One of the interesting things about the term universal life is that it does allow for a 1035 exchange into new insurance if that's the objective, and cost basis can be carried over. We say it's typically not a real good long-term play, and there's generally no option to convert. So most of these policies can be continued after the level premium. And what will happen is either the face amount will drop down from $1 million to $60,000, and you can continue to pay the same amount of premium or whatever amount, or you can pay a substantially increased amount to keep the policy going for whatever period of time you want to. Okay. The concern I have with using a term universal life long term is that you really don't, the owner does not get any advantage of the pricing and product improvements. So what does guaranteeing these policies really mean? Well, it depends on what kind of policy we're talking about, but they could be based on cumulative premiums, based on cash value, based on meeting policy provisions on a timely basis, or based on the minimum interest rate, which is most popular with the most common form of it, based on the minimum interest rate and the maximum expenses. Okay, and so it's important that when you're ordering in-force ledgers, because of these guarantees and because of the moving parts, that you're asking for a summary of the policy's annual expenses. And they almost any carrier that I've ever dealt with has that capability, but they require you to request it before they automatically provide. So, on the other hand, that was a lot of information, but the universal life statements that you're receiving on your policies do have some of the key information to determine if you have a problem policy or not. So this is and again, I apologize for the bad copy. We'll highlight the key aspects of this, but this is a major carrier that issues a lot of insurance and trust, and if you're managing or have managed insurance over some period of time, or you're managing insurance now, you've probably seen an annual summary that looks like this. All right. So, what are the key elements of this? Well, one of the key elements is this report right here, which is the accounting, the annual accounting on a monthly basis of what exactly happened with this policy. So, as you can see in this particular policy, the premiums were received monthly of $500. The admin charges were here, $140 a month. There's the interest at the guaranteed rate, which is this column. The total rate percentage now is 3%, meaning that it's actually crediting at the guaranteed rate during this period of time. So there was no excess interest credit. There's the cost of the insurance, cost of the riders, any surrenders, and so forth. So there's the end of the policy value every month. So I look at this policy and say, all right, it looks fairly healthy to me, given what I'm seeing. The cash value grew by, you know, $4,000 with $6,000 of premium, so that doesn't look too bad. So, you know, right. So my initial reaction to this monthly policy activity summary is that it doesn't look like we have a problematic policy. This is really the area that you're looking for that has the critical information, and not all carriers provide this, although all carriers should provide this. What this is the projected expiration date of this policy based on certain factors and variables. And so the variables on the top line here are planned premiums paid. So in other words, if this person continues to pay the $500 a month and the expense structure doesn't change, and the interest rate doesn't go up, because it can't go down any further because it's paying the guarantee, this policy will make it to January 2043. All right. So one of the ways you can tell is you retain your annual statements if the mortality costs have increased in your policy, or if the expenses have increased in your policy, to see if this date changes when you get annual statements in the future. It's an easy way to tell whether you might have a problem in the policy or not. In this particular case, this individual will be 97 years old at that point, and I don't know whether that's a problem or not. Depends on his health. Based on the guarantees of the policy, and again, this would be the maximum expenses and the maximum mortality charges, which they're not charging now, but they can in the contract. This policy will make it to the year 2020, 2030. And of course, the same information if no further premiums are paid. All right, so this is just a good way to get a quick assessment on the policy that you're managing to see if the policy seems to be in some kind of problem status. All right, so at this point, that concludes my information to share with you about Universal Life. Now I'll turn it over to Steve, who we all know is the remediation expert when it comes to fixing insurance. So Steve, take it away.
Steve, can you hear us? Are you there on the line? Hey, Mike, Mike, can you hear me? We're having a hard time hearing Steve. His audio isn't coming through on his end.
Okay. You want me to just finish this then?
I see that he's got control, but yeah, Steve, can you hear us? Not getting anything over from his end right now.
All right, you want to turn it back to me?
Yeah, absolutely. Should have control.
Okay. Is this the next screen? Because we skipped a couple of screens. There we go. Okay. So so this is the remediation process, or excuse me, this is the review process that we follow for Universal Life. We call it a 10-point checklist, and this is something we will be providing you all after this meeting, the PDF form. Okay, and so this is the process that we follow. So first of all, just the mere fact that we have a written process to follow is a good step to take in the regulatory environment that we're in today. All right, and what is that process? Okay, well, the first thing is we want to figure out what the projected lapse date is based on the current premiums. We just talked about this, current cash value, and what the survival probability is of the insured. What's the required? So next we want to figure out what is the required premium to reach maturity of the current policy or a target date if there is some change in objectives or health. Or we'd also request a reduction of the face amount, or recommend you request a reduction of the current face amount down to a level where it looks like it will meet maturity or a revised target date using the current funding pattern of the existing policy. Then look at if the insured appears to be healthy enough to qualify for insurance, obtain open market bids that compare the current death benefit and the reduced face option to what the current the options are on the current policy. Then, if everyone is in consent, then you would initiate a multi-carrier negotiation process that would begin with an informal application and a HIPAA form with a trusted insurance advisor, licensed broker that could help navigate you through that process. Compare the new offers to the current policy. than before. We would highly recommend before any policy replacement before any policy replacement takes place, find a third party to do a replacement analysis so you have independent confirmation that this replacement is in the best interest of the beneficiaries of the trust. And of course, always document any meetings, conversations, and obviously reasons for the exchange. Then, once the remediation has taken place on either fixing the existing policy or the client signs off on that they don't want to fix the existing policy and they're okay if it's at risk, they're okay leaving it as it is, then monitoring the policy annually at that point is critical to make sure that all the work that you've done and the changes you've made to correct whatever problems you have that you're managing, that's being monitored. And we would actually recommend you have third party do those reviews. So here is a takeaway. This is our in-force universal life in-force ledger request, and these are the questions we're asking. We're asking for the information we just discussed: current in-force ledger illustration at current funding and crediting rates, current illustration solving for premiums at 1% below, and then current in-force illustration at funding level needed to maintain the death benefit until age 105, or an adjusted target date. In the fine print, you'll see on here that we were going to spend a little bit of time on it, but we ask for these projections to be done without them utilizing any non-guaranteed persistency or crediting bonuses. This is a game that some carriers play where they, without guaranteeing this, say that if you leave your policy in force for so long, that we'll actually give you a bump in your crediting rate. Sometimes that happens, sometimes it doesn't, but it certainly makes an illustration look a lot better to bump a return, a 0.5% or 1% over a long period of time. And so if it's not guaranteed, we wouldn't recommend basing the projections of an in-force ledger or in-force policy based on non-guaranteed bonuses of that kind. And then, of course, we're asking for confirmation of beneficiary, whether there are persistency or crediting bonus, and the rest of this information you see below. What you'll find is using this, you'll get some of this information. Most carriers will not automatically give you all this information. So in most cases, you'll have to go back and ask additional questions to get everything on here that you're looking for to do a policy review. Okay, so that's it for our presentation today. We brought it over a couple of minutes longer than we had intended. If you're looking for resources, there's a website there at the top, which is the treadlightlyguide.com/Trust Central. There's the in-force request for all different policy types. There's white papers on there. There's a bunch of information on there that might